This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
And we've nearly got everything for the balance sheet. Oh, we've got everything for this one, but anyway. But just checking you're happy where we were. The goodwill on consolidation. I'm sorry, keep repeating, but it's these workings. You know, as I said before in the exam, it'll be what's this figure or what's that figure and so on. But see the sense of it. What we're trying to do is at the date of acquisition, we're saying the total worth is what we were prepared to pay for our shares together with what we think the other shares were worth. All right? And I've said I'll come back to where that figure comes from, but the question told us we paid 40 for ours, the others were worth 30. In which case, you are all clear what I mean? The total worth was 70. What did the balance sheet show it as being worth at that date? S's balance sheet, the share capital would have been 20. The retained earnings we know were 6. So on the balance sheet, S would have been worth 26. Why is the true value more than the 26? Since there's no fair value adjustment, and there almost certainly wouldn't be, the extra, it must mean the goodwill on that date was worth 44. Clear? Retained earnings? I think that should be very sensible. We're entitled to all the retained earnings of P. Clearly, only our share of the retained earnings of S. And only our share of the earnings since the date we bought it. All right? The earnings before, well, it's part of what we paid for in a sense. And finally, the non-controlling interest. How much are they worth today? Well, we're saying they were worth 30 at the date we bought our shares. They're now going to be worth more because S has been earning more money. The extra is their share of the earnings since the date of acquisition. Okay? So it's those three sets of workings you must learn. All three will be asked, but as separate questions. What's the goodwill? What's the non-controlling interest? What's the retained earnings? The balance sheet itself you can't be asked for, but just see how it all fits together. The consolidated balance sheet, or statement of financial position. Help me here. But non-current assets, we simply add up. P50, S30. The total value of assets in the group, 80,000. We control all those assets. It's irrelevant that we don't actually own them all. We control them. Again, there's no fair value adjustment. It is unlikely, but had there been a fair value adjustment, you'd add it on. This new asset only appears when we consolidate the goodwill. But the total value of the goodwill, can somebody look back? Was it 44,000 from the workings? Again, we don't own it all, we only own part of it, but we control all of it. There's the total value of the goodwill. The current assets. Simply add up. P has 14, S has 12, 26. Yet again, although we don't own all of those, we've only got 60%, we do control all the current assets of the group. And so the total value of assets in the group, 100 and, is it 150? 150. Now clearly there are current liabilities, we'll show them later. But subject to that, who owns this? Well, we've got total assets, but of course we don't own all of them. What do our shareholders own? We own the share capital of P, obviously. It's our shareholders we're looking at. So always, all of P's share capital, which was 50. In addition, our shareholders, what are their retained earnings? We did the workings. It's everything of P. It's our share of S's post-acquisition earnings. We've done the figure, what was it? 50,000. I've picked the right figure, I hope. 50. So our shareholders own 100 of the total. But of course the reason we don't own all of it, we've brought in all the assets, but some of it is owned by the non-controlling interest. How much is owned by the non-controlling interest? Again, we've done our workings. It's 34,000. And so in total, we owe 134. 100 belongs to ours. 34 is these other people. And of course the bit remaining, but we had to leave it till the end. There are, of course, current liabilities. But again, a straight add up. The total current liabilities of the group, 10 in P, 6 in S, 16. Of course it does add up. So we're saying the total value of the group, of course, is 150 less the liabilities 16. The group is worth 134. Who's the 134 owed to? 100 to ours, 34 to the others. Okay? So yet again, as I keep saying, they cannot ask you to do a balance sheet. But even so, I think it's nice here. It sort of makes sense, I hope, of what's happening. Okay? Now we're virtually there. In a minute, there's just one more thing you could be asked to deal with on the balance sheet. But otherwise, is that making sense? Just one thing which relates to what Irina said, which isn't going to be a problem for the exam in paper F3. Everything I've done is right, and in the exam, that's it, and you learn it, you know? You all saw where the figures came from. But one problem in real life is when we worked out the goodwill, you all, I hope, see the idea, because I've said it twice, if not 3 times. We're trying to compare what the business, what S was really worth on 1st of January, compared with what the balance sheet showed it as worth. You were all happy about that, the sense of that. And of course, what the balance sheet showed it as worth, I don't think there's any argument, 26. If shares were 20, if retained earnings were 6, the net assets must have been 26. The problem is, how do we know its true worth? Obviously, the shares we bought, clearly we thought were worth 40. That's why we paid 40, clearly. There's no argument there. But we needed to know, to get the full worth of S, we needed to know how much the other 40% were worth. You agree? Now, in real life, that is a problem. How do you know? You know, I say again, I know how much my shares were worth because that's what the amount I paid for them. But how do you know what the rest of them are really worth? You know? And in fact, what you'd probably do in real life, I suppose you could get valuers in. Or what you might do is say, oh, well, if our shares were 60% of them, yeah? You might say, well, if ours are worth 60%, I beg your pardon, if our 60% is worth 40, you might say, oh, the other 40% must be 40/60ths. of 40,000. Are you with me? Now don't write it because you wouldn't have to do it. But you might do that. So you might get valuers in. Or you might just say, they're worth whatever proportion of our value. You're all with me? Or you might even say, there'd be a big good logic for this. You might say, they're actually going to be worth a bit less. I think you'd agree that if you're buying control of a company, you're likely to be prepared to pay a bit more than if you were buying uncontrol, if you understand me. So in real life, it can be a problem. In the exam, though, you'll be told... Now, this is actually rather unlikely. It's very unlikely the other 40% would be worth so much if our 60% are only worth 40. It's very unlikely. But in the exam, as I say, at F3, it's not your problem. If I tell you the non-controlling is worth 40, it's worth 30 rather, it's worth 30. If I said it was worth 10, it's worth 10. I think you understand what I'm saying. Okay? So that was the point Irina was making, wasn't it, effectively? Why is it worth 30 sort of thing? Well, I hope I've answered you properly. I say, when you come to F7, there's not much more, but there might be a bit more involved there. But just one last time at F3, if I tell you it's 30, it's 30. And clearly you don't sit and complain, you assume it's 30 and off we go. The arithmetic itself's not hard. Okay? So are we all clear? All right. Well, as I say, there is only one thing left in F3 as far as the balance sheet's concerned, which, now I should have told you actually, I don't know if you've noticed, that one we've just done, in fact we've done 3 examples I think in the notes. Example 2 only actually asked for the goodwill and we did that. Over the page, example 3 says what's the non-controlling interest and we did that. And over another page, example 4 says for example 2, what's the retained earnings? And we've done that. You with me? And finally, example 5 says, do the statement of financial position. Well, we've just done it. So we've actually done 5 examples at once. I am sorry if you were squashing all of that when I'd left all that empty space. Although it does mean if you've not filled in those other sheets, you can do the example all over again without looking, you know. Anyway, we have done, I'll say I've split it up in the notes, but we've done examples 2 through 5 here. We've done the balance sheet. And so the only remaining thing is page 156, which is headed up, it sounds exciting, inter-entity transactions. All right? And listen carefully. One bit of this is very easy indeed, I think very obvious. The other bit isn't hard, but slightly more thought. What we're talking about here, remember, we've 2 companies, P and S, or whatever they're called. The situation we're talking about here is suppose P and S trade with each other. You know, clearly, I might have a company that owns 60% of Liga's company, obviously. But completely separate from that, my company might buy things from Liga's company. Or Liga's company might buy things from me. Would you agree? And there are 2 problems that can result from that. The first, the most obvious one, is just suppose I own Liga, and at the end of the year... I'm selling goods to Liga. Suppose at the end of the year, her company owes my company 5,000. All right? Now, surely, in my own accounts, Liga's a customer, so every time I sell her goods, debit receivables, credit sales. In Liga's own accounts, she's buying goods from me, and every time she buys goods, Debits, purchases, credits, payables. True? But at the end of the year, if she still owes me money, in my accounts, as part of my receivables might be, let's say, 1,000 owing from Liga. And in Liga's accounts, if she owes me 1,000 at the end of the year, in her accounts, including in her payables, will be 1,000 owing to me. But surely, when I do the accounts for the group, the consolidated balance sheet, we only want to show the total owed from outsiders, the total owed to outsiders. It's a bit silly, surely, showing for the group that she owes me 1,000, but I've got a receivable and she's got a payable. You understand what I'm trying to say? Put the two together. And so this is terribly, terribly easily dealt with. If in the individual accounts you've got one company owing another company, when we come to show the accounts of the group, the consolidated balance sheet, we remove any inter-entity owings. Now, I hope I'm making sense, but hopefully to make it 100% clear, look at example 6. Example 6. A little extract. P has a controlling interest in S. So you know what that means. P owns more than 50% of S. Okay? And remember, whatever percent it is, if we control, in the consolidated accounts, we want to show total receivables, total payables, total current assets, total current liabilities. And here, all right, P's got receivables of 50, S 30. In their own accounts, P's got payables 35, S 40. But included in P's receivables is 8,000 owing from S. And included in S's payables is this 8,000 that's owed to P. We all clear? And it says, on the consolidated statement of financial position, what will we show for total receivables, total payables? Total receivables, total payables. Well, surely, what would you normally do? Normally, we simply add up. I know we've only done it for current assets in total, but clearly we're adding up. And so the total receivables, P is 50, S is 30. Normally, you'd say 80,000. But included there is surely, included in P's 50 is 8 owing from S. Well, take out that 8. We only want to show what's owing from outsiders. And the total owing from outsiders, it's 72,000. Is that sensible? And similarly, payables. As always, normally, we simply add up 35 in P, 40 in S. Normally, 75 finished. But, of course, there's 8,000 included there as well. In S's figure is 8 owing to P. Well, we only want to show the amount owing to outsiders. Subtract the 8. We'd show, what does it come to? Is it 67,000? Hello? Thank you. Does that make sense, everybody? Thank you. I think that's very sensible indeed. I really do. And of course, even though it's only an extract, I think obviously things are going to balance. If there wasn't the 8 owing between the two, add up and you've seen lots of times now it balances. Subtract 8 from both, clearly it still balances. Well, I think that's very obvious indeed. I think that's very sensible. Okay? So, that's problem number 1, the easy one. It's only obviously if there's an amount showing at the end of the year. If at the end of the year no money was owed between us, then the figures would be just outsiders. You wouldn't have the problem. The other problem is easy, but just a tiny bit less obvious. If it's Liga and I, if I'm selling goods to Liga, we are two separate companies, despite the fact that I own shares in her. And if I sell goods to Liga, I'm likely to sell them at a profit. Would you agree? I'm not going to sell Liga goods cheap just because I own some shares. Maybe I buy goods for 10 and I sell them to Liga for 14. All right? No problem. And in my accounts, obviously, if I've sold goods to Liga at a profit, that profit is part of my profit in my income statement. No problem. Well, the trouble is, when I come to do the consolidated, there's no problem at all, provided Liga has sold those goods to somebody else. Think about this. Just think, you don't need to write these figures down, but if Company P, the parent, if they have goods that cost 10, if they sell to S for 14, P's made a profit of 4. Everybody happy? S bought the goods for 14, S bought the goods for 14. Oh, shit. And if S has carried on and sold them, if they've sold them to other people for 20, in S's accounts, they'll have a profit of 6. Now, am I making sense here, everybody? So I sold them to S. I had a profit in my income statement of 4. It'll be in my retained earnings. S bought goods and sold them, made a profit of 6. And it'll be in their income statement, 6,000. It'll be in their retained earnings. Well, what about the group as a whole? We're just going to add everything together, and no problem. The group as a whole, they bought from outside for 10, they were sold outside for 20, the total profit is 10. No problem at all. But where there is a problem is this. Suppose S hasn't yet sold them. Okay? They're going to sell them, but suppose these are still in inventory. Agreed? Well, in my own accounts, I'm showing a profit of 4,000. S hasn't sold them, so she's not showing any profit, yeah? But she'll be having inventory of 14. But when I come to look at the group as a whole, how much profit has the group made from these goods? 0. The group as a whole hasn't made any profit at all. Because the group paid 10, the group hasn't sold them outside. Do you see my point? Now, in my own accounts, I am showing 4. In my retained earnings is my profit, 4,000. S hasn't got any. But when I come to add together, I've got 4,000, and yet the group hasn't made that money. And why hasn't the group made the money? Because it's still in inventory. If S had sold it, there's no problem. But because it's still in inventory, the group hasn't made that 4,000 profit. And as you'll see in a minute, what we're going to have to do when I come to consolidate, my accounts, that's included in my retained earnings. Do you agree? It's part of this year's profit. And we're going to have to say, because the group hasn't made that profit, we're going to have to subtract it from our retained earnings. Would that make sense? But one other thing. In S's balance sheet, she's got inventory of 14. But when I come to do the accounts for the group, clearly we add up the inventory. But as far as the group is concerned, the inventory shouldn't be valued at 14 at all. Why? Why shouldn't the inventory be valued at 14 for the group? You should value the lower of cost and selling price. Well, as far as the group is concerned, it didn't cost 14 at all. It only cost 10. Do you see my point? And so, because that 14 is still in inventory, S's own accounts show it at 14. My own accounts include a profit of 4. But because it's still in inventory, when I come to do it for the group, I need to reduce retained earnings by that 4,000. Because the group hasn't yet sold it outside. And at the same time, I need to reduce the total inventory of the group by 4,000. Because the group didn't pay 14. It includes this profit that's not a profit for the group. Okay? There is a name, although I'm more concerned about the numbers, and I think you've understood me and we're about to do it. That profit that's in the inventory is called unrealized profit. The unrealized profit I'm not going to write an essay. I think what I'll write is enough to remind you. I think you understood me. But the unrealized profit is the profit on inter-entity sales that are still in inventory. Inter-entity sales between P and S. It's only if any of it's still in inventory. Again, if it's all been sold, the group has made the profit. Any of it that's not been sold, though, we've got this profit there, which the group hasn't made because we've not sold them. Okay? Well, if you have understood me, I think dealing with it is relatively easy. It's just one more thing to be careful of. So let's do one last example.